Recently, the Bank of England increased their interest rates once again. They've also forecast a downturn in the economy. This is clearly going to impact everybody, including property investors. In this video, I want to share what you need to do to protect your finances and investments, but also spots the opportunities that are going to be coming. Hey, if you're watching my videos for the first time, my name is Saj Hussain, and on this channel I share with you my 15 plus years of property investing experience to ultimately help you get further faster in your own property investing journey. So after the fourth consecutive rise of interest rates, the Bank of England base rate now stands at 1%. This is the highest it's been for the last 5 years. However, at the same time, it's the lowest it's been in a very long time as well. Now, the government will use interest rates to try and control inflation, which is currently estimated to be above 10% by the government before the end of the year. The reality is it's probably way above that right now. It's probably more than 10% right now. And before the end of the year, it's probably going to be significantly higher. But the official rates right now running at about 7.5%, expected to be about 10% before the end of the year. Now, what the government will do is increase interest rates, which means it puts pressure on spending. So people will be borrowing less money because it's more expensive. The expenditure will go up. For example, any loans they currently have, the biggest one being the mortgage. So what that means is they have less money to spend, so they're spending less money. This helps control inflation, but at the same time, it slows the economy down as well. Now, the government will increase interest rates even though it realizes it's going to negatively impact many of us. However, the government feels this will be worse of the two evils, i.e. inflation getting out of control, which will be far more worse for the country. There are many reasons why inflation is rising. The government is blaming it on things like the fuel increases, such as gas and electricity, the Ukraine war right now, Brexit. There's so many different excuses, but whatever those excuses are, the reality is we are here facing this situation. So how is all of this going to impact the property market, you might be wondering? Well, there's many different ways it will. For instance, one of the things that will happen is as people's mortgages become more and more expensive, which is one of their major expenditure each and every month, that people reduce their spending. People won't be thinking about moving house. They won't be thinking about selling or buying. There's approximately 2 million people in this country whose mortgages are what we call variable or either standard variable rate. What that means, they're not fixed. So when the interest rate changes, their mortgage products are such that the monthly payments will then also change as well. So an increase in interest rate means an increase in monthly mortgage payments. To help put this in some kind of context, if you think about somebody maybe paying, say, an interest-only mortgage of, say, about £300 a month, and then the interest rate doubles, and it's not going to take very much to double right now from, say, 1 to 2%, and that interest rate doubles, that means their monthly payments will double from £300 to £600. You could already start seeing small increases in mortgage payments will have significant impact on people, because people won't necessarily, many people won't realize that what the rates that we are seeing right now is not the norm. In fact, if you roll the clock back about 20 years, many mortgage rates were about 6 or 7% at that time. One of the biggest challenges many people face is that they work in a job, which essentially stands for just over broke. And what that means is at the end of the month, whatever money that they have, they've already spent. So next month, they've got to start again from effectively zero. Very few people have any savings that can last them more than a few months if their income was to stop. For many, what that means is before that money even arrives in the bank, on payday, it's already been allocated and spent. So when there's significant increases in costs, for example, mortgage costs as we're talking about, this can sometimes lead to the straw that broke the camel's back. So what sort of size numbers are we talking about when we talk about increase in interest rates and the impact on monthly mortgage payments? Well, let me give you some context to break that down. Let me break down some of those numbers. Let's say you have a £100,000 mortgage, and then you have an interest rate increase of 0.25%, so like 0.25%. So what that would mean is that would be an increase of a interest payment of £250 per annum, but per month what that translates to is £20.33. So a 0.25% increase in the interest rates on a £100,000 loan means an extra £20.33 a month. Doesn't sound too bad, but actually let's say if it's a 1% increase as opposed to a 0.25% increase, so that would mean actually this goes up to £1,000 increase per annum, and then your monthly payment is now £83.33. So an increase of £83. Again, probably most people could probably manage that, but most mortgages aren't 100,000. Let's say if someone has a £250,000 mortgage, yeah, and then we've still got a 1% increase in interest rates. So now this is £2,500, and what this translates to is £208.33, if my maths is not wrong, per month. So now a 1% increase on an average mortgage, interest rates wise, is £200 a month. Again, now it's starting to feel the pinch a little bit, but we're still talking about small numbers. Let's say the interest rate goes to 2, 3 or 4%. You can now see how this increase here can make a massive difference to somebody. Now, if this is the interest only we're talking about, for many homeowners, their mortgages are repayment. So it's not just this amount that increases the interest, but the amount of capital they're having to pay each month is increasing as well. So what is it that you should be doing right now? The first and most important thing is don't panic. The people that are in charge of this country, they are not going to let it grind to a halt. They're not going to bring the country to its knees. They are not that incompetent. The next thing that you absolutely must do is subscribe to this channel. This is where you get the latest information on strategies, techniques, what's going on with the property market. So make sure you subscribe to the channel. It's absolutely free. Just hit that subscribe button. Next, then, is review your current products you already have at the moment. If you've got a number of mortgages, look at those mortgages and look at the terms of those mortgages. i.e., are they on a fixed rate? Are they on variable rates right now? Because if they're on fixed rates, then your mortgage interest rates are not going to change during the term of the fixed period. However, you need to be aware when they might be coming out of those fixed periods. So if it's going to be happening soon, say in the next year, you might be wanting to speak to the mortgage broker now early to start those conversations of what the alternative options might be that you may be able to switch to. If, on the other hand, you're on a variable rate, you might want to consider possibly fixing it into a longer term to give you some certainty. Or if you're a bit more open to risk, then just be mindful that as it might change. Because when you're fixing the product now, you are going to be fixing at higher rates, because the banks will also be planning ahead and think, well, actually rates are going to rise. They don't want to be in a negative position where you're paying a much lower rate than the Bank of England base rate is. So the rates that you will have, you'll probably pay slightly more the longer and longer that you fix them. And if you are renting to tenants right now, look at your tenant's position, what kind of jobs they're in, how comfortable they are or uncomfortable they may be getting right now, just to be aware of what their financial position is and how it might impact you. And in some cases, you might want to consider increasing the rents, because they have increased considerably over the last year in terms of market rates as well. We found across our portfolio that generally we tend not to increase rates, rent rates, that is when tenants are in doing their tenancy. We tend to wait when that property becomes available or that room becomes available. At that point, we review it, what the market rate is, increase it then. However, this is the first time in about 10, 11 years that we've increased rates during a tenancy. And the reason for that is because the massive increase that we're facing on gas and electricity bills, and many of our tenancies are inclusive of all bills. Next thing to do is remember that strategies evolve with the market. So certain property investing strategies work much better in certain climates and conditions. So for example, when the market's say starting to slow down, you start to pick up more below market value property. When the market's rising quickly, it's very heated like it is now, then you'll find you'll struggle with below market value. So just like that one strategy evolves depending on what's happening in the market, many of the other property investing strategies also involve. So make sure you're clued up and using the right strategies for the right time. It's not just understanding them, but applying them in the right way. And of course, if we can help you with any of that, we run a number of workshops on strategy, utilizing them, and also supporting you to get the best results possible from investing in property. Now, you may also be speaking to people right now that are sitting on cash and a little unsure what to do. They can't find the right deals, or they're not sure where to invest, but they do know inflation is rising, and that means their money is depreciating in value. Its buying power is going to be significantly less in 1 year and 2 years' time. So you need to be thinking about how you can work with those people, help them invest in property, either as a partnership or they're investing with you, so that not only they benefit, but you benefit and you start building your portfolio as well. Because remember, in 10, 20, 30 years from now, it's very likely prices are still going to be significantly higher than they are today. Many of us believe that. That's why we invest in property, because we know long term that's where it's heading. Now look, these are just my views. None of us have a crystal ball, but what we can do is base it on our experience of understanding the market and what goes on in the market. And one of the reasons you watch these videos is because you want to understand what's going on in the market as well. So what to do next is to click on my face down here to subscribe to the channel. And once you've done that, then what I'd like to do is click on this video over here where I talk about what I believe is going to happen next in the property market. So look forward to seeing you on this video over here.